Hello and welcome. In this lesson we will continue with the corporation tax. In the previous lesson as well we looked at the basics of corporation tax. Now we will look at some additional aspects which are relevant to corporation tax. Now if you remember from your earlier trading profits, we used to make the trading profits. So when we are calculating the trading profits for taxable purposes, what we used to do is we used to add some expenses which should not have been deducted in the first place. Like the example was depreciation, for example. So we used to add back the depreciation in our trading profits. In the same way, like we do for depreciation, something called amortization is also added back. And you know about amortization, it is on the intangible assets. So it is basically a depreciation on the intangible assets. Like say for example Goodwill. So the impairment on the Goodwill or the amortization on the Goodwill will be added back into the trading profits or the corporation tax, the company profits. Alright, so we will look at some additional aspects like that as I will share the screen with you of our notes. As you can see on your screen, I've already shared the screen with you. As you can see on your screen, our first topic is Goodwill. Now, as I said to you that expenses will be added back. So expenses like, say for example, depreciation in our trading profits we used to add it back. So we will add back the amortization as well if there is any. Now, in this notes it says amortization in Goodwill is not an allowable expense. If a company has deducted amortization on Goodwill, then it must be added back in calculating the trading profits or the company's profit. Now, gains or losses arising on the Goodwill will be calculated in the same way like you do for the accounts. So there won't be any special treatment for the taxable for the tax purposes. So it will be exactly the same like we do for our accounting profits. So it will be exactly like the accounting profit. So it says that gains and losses arising in the Goodwill are recognized for tax purposes on the same basis as they are recognized in the accounts. Profit or loss on the sale of asset will be sale proceeds less net book value. So we'll deduct the net book value out of the sales proceeds, which means that it will be taxed as a trading income instead of capital gains. So we'll take the market value and we'll deduct the net book value, and the remaining one will be our profit or loss on the asset, as far as a Goodwill is concerned. So it will be treated it will be treated under the it will not be treated under the capital gain. So it will be treated as taxable profits. Now we know about Goodwill. As I said, the amortization and the Goodwill will be added. Now next topic is our patent box. Let me move to my notes. It is page 77 of the P6 notes. So let me just move to the notes. So patent box, what does it say? Now you know about patents. I assume so. Now patents are simply authority to make something, or you can say it is your copyright. Say for example, if you are doing a business and you're doing quite well. Now after some time, when you thought your business was quite well, then what you thought about doing, that you registered your business. Also you have registered your business so that your business will be registered and no one else will be able to use your name, say for example. Alright, so say for example you were making a product which was very, very special product, and it gone very, very famous. Now because you were gone very, very famous, people might use your name without paying you anything, and they might use your name and take advantage of using your name. So in order to avoid that, what you have to do is you can register your patents, you can register your copyright. So when you register your copyright, then no one will be able to use your name to sell the products. Excuse me. So no one will be able to use your name to sell the products. So no one will be able to use your copyright or your Goodwill, because you have already registered the copyright or the or you can say patents. Now although you have registered it, so when you registered it, your business was quite well. So what happens is when businesses are doing very, very well, then they register the patents. Otherwise, there is no need to register if you are not doing well, because no one is going to steal your patents. If your business is quite well, then after registering the patents, then people might come to you and ask you, can I use your name? So then you might allow them to use your name to sell the products, and you might charge in exchange for that. That might be royalty, you can say it's a royalty. The charge which you're getting, so the payment which you are being paid for letting others use your name, so you can earn something out of the patents or out of the copyright. When you earn something by selling your copyright, that is also one of the sources of income which you can earn. Likewise, you might be selling some products which by using them patents, by using them copyrights. When your business is doing quite well, then your product is only selling because of your name. So when you are making your product, when you're making the product, and that product is being made by using the patents, that product is being sold by using the patents, then that product is giving you money because of that patent. So the patent money, the money that you can earn from the patents, is of two sorts. One is when you sell a product by using the copyright, and the second one is by letting others use your name, so that the sources of income from the patents are of two types. Now, what the UK government says is that government wants you to do the business, and government wants you to do the business in a very good way. Now, when you flourish, when you do a good business, then the government will be happy, because you will be paying the taxes, and you will be hiring the people as well. Now, what the government says is that when you register a patent, then the government will give you benefit in the taxation. So you will have to pay less tax when you have registered your patents. So how much less tax we have to pay when we register the patent, that is our next topic area. Now let's look at the notes now, which says the patent box. Now a new scheme has been introduced in relation to the patent profits in order to encourage companies to develop and exploit patents. The broad effect of the scheme is to tax profits arising in respect of patents at a low rate of corporation tax. This scheme is available to companies that carry on qualifying developments in relation to a patent, and is optional. So this scheme is optional to choose. If you want to choose, you can do that. The scheme is applied to all profits relating to exploitation of patents and royalty income rising directly from the patents. It also applies to a proportion of the profit on the sale of the product. So the income could be in two ways from the patents. One is by letting others use your patents, and other one is when you sell the product where the patent has been exploited within the production process. Now, how much less tax we have to pay? Only 80% of the patent profits are taxed at an effective rate of 10%. So the tax rate is half of what the normal rate is. Corporation tax rate is 20%, whereas if you have used a patent and the profit is related to the patent, then you only have to pay 10% tax. And not only you have to pay tax at the rate of 10%, but only 80% of the patent profits will be taxed. So there are two benefits. One is that only 80% of the profits will be taxed, and other one is that you will have to pay the tax at the rate of only 10%. All right. Now, in relation to that topic, there is one question about it, I think, which is question 28. I've already listed down the list of questions. So for question 28 is relevant to patent box. Let me go to the exam kit and find question 28 so that we can look at that question as well. All right. So question 28. Here's the question 28, and let's read the requirement. Now, if we go down to the requirement, and where it says part B in the requirement, it says Unger Limited patent box. So it is asking about the patent box, and it is worth 5 marks. Now, if we just go above the question, so where it says part B, now Unger Limited, a state giving reasons why whether or not the patent box is available to Unger Limited, and briefly describe the operation of this regime. All right. Now, how can we do that? We'll have to read the question. Now, if we go below that, sorry, if we just go on the top of the question so that we can read about that, where the Unger Limited is. Let me see. So this is the question 28. Here it is, Unger Limited. Now it says the trade of the Unger Limited consists of baking high quality cakes. Unger Limited trades from premises purchased on 1st of July 2015 for £310,000. Now these are the premises which were purchased for £310,000. Unger Limited also develops new baking processing techniques which it has patented. It uses these processes and techniques itself and licenses the patents to other manufacturers. Alright? Now, it is using the patents and it is letting others to use that techniques. So it is licensing its techniques, and it has patented that as well. So people are using their patents as well, and they are making the products out of that as well. Now this question worth 5 marks. Now all the data which I've already told you, you can just write down straight away. So it will be exactly in the same way like I told you. So it is question 28, and it is part B. So please make sure you read the answers when you have time, when you finish this lecture. So it is question 28 part B, and it is a past exam paper. It was examined in December 2014. So what you have to say is that because they are using special techniques and they have registered their patents as well, so what will happen is they will this new patent box regime will apply, and they will have to pay, Unger Limited will have to pay tax at the rate of only 10%, and only 80% of the profits will be, patent profits will be subject to tax. So only 80% of the patent profits will be subject to tax, and they will have to pay tax at the rate of 10%. So these are the things that you will have to say, and you will have to say about both of the stuff. So what he is doing is, Unger Limited also develops new baking and processing techniques which it has patented. It uses these processing techniques itself and licenses the patents to other manufacturers. So the sources of income are two. So others are using their patents as well, and Unger Limited is charging them to use its patents. So that income and the patent profits, so the processes, the cakes which he is making by using the patents. So when they sell them cakes, that profit, and when they let others use the patents, both profits will be subject to 10% tax, and only 80% of the profits will be subject to tax. Alright, so that was question 28 part B. Please make sure you read the answers when you have time. So I hope it will be in the same way like just the way I told you. Alright, let's move to our next topic, which is transfer pricing. Now what transfer pricing is, you might have seen it in other papers. If you have given P5 for example, or F5, you have seen a transfer pricing there. You might have seen it in F9 as well. Now transfer pricing, you know about the basics of transfer pricing is, it applies in a different, in the same company. So when the company is huge company, so when one department transfers the goods to other department, so whatever the price they are charging, it is called transfer price. The price at which the company is transferring the assets, that will be a transfer price. Now what happens is, when a company has lots and lots of companies within a group, so they are part of the same group, what happens is that what they do is they transfer the product which they are going to sell outside the group. So say for example they made a product and they are going to sell that product at £100 in the outside market. Right? So they are going to sell it for £100. Now when they sell it for £100, they have made a profit of £50 on that. Now they have made a profit of £50 on that, and £50 was cost, so they will be subject to corporation tax at the rate of £50. At the profit of £50, because the £50 was profit. Now in order to avoid this huge profit, and so what the companies do is, they transfer, say for example there were different companies within the group. What they do is they transfer from one department or from one company to another company. So they sell the product at a higher price. Say for example they sell that product which they are going to sell at £100 outside, they sell this product at £100 to this company. So they first sell to this company and then they sell to outside company. So the eventual aim of doing this is to charge less, to show less profits which they are making to outside individuals. Say for example, first they transferred from one department to other department at £100. All right, so that was transferred to that was transferred at the rate of £100. So when they sell to outside market, so their cost will be £100, isn't it? But they sell at £110 to the outside market. Now their eventual profit is quite high. If you see, they are selling at £100 and their cost was £50, but the arrangement of the transaction is such that the eventual profit is showing at just £10. So the aim of it is to pay less tax, to show less profits. So in order to avoid that, this rule has been introduced, which is transfer pricing rule. Now what this rule says is, whenever you transfer a product, you have to take the market price instead of whatever price you may choose. So what the people used to do, what the companies used to do was, they used to charge whatever price they may choose, but what tax authorities have said that you must choose a market price instead of your own choice. All right. So the transfer price legislation restricts the freedom of companies, freedom for group companies to buy and sell goods or services at whatever price. There is anti-avoidance legislation which requires the profit to be computed as if the transaction had been carried out at arm's length. Now arm's length means market value, and not at the price actually used. So you cannot use the price you want to choose. All right. So that is called transfer pricing. Now this was just a theory. It was relevant only for theory. It is not relevant for any sort of calculation. Our next topic is relevant to research and development relief. Now, as you know that you have studied research and development in financial accounting, but we are not studying the financial accounting bits. We do not need to know the definition of research and development, and we do not need to differentiate between them. However, for tax purposes, what the UK government says, what the tax authorities says, that when you do some research and development, and if it is a qualifying research and development, then you will get some relief. Now the relief will be, if you remember, if you know that when we take the incomes, so we take the income and we deduct the expenses out of that, the net amount is going to be our profit, right? So when we take our income, so we have taken our revenues and we have to deduct the cost out of that. While deducting the cost, one of the costs will be our research and development, because that is also our cost as far as taxable profits are concerned. So we'll take the revenue and we deduct the expenses, including research and development expenses. Now what we do is we just deduct the research and development expenses, whatever they are. Say for example they are £100, we deduct the £100 out of that. Now what the HMRC says that if the research and development are qualifying research and development, then if your research and development expenses are £100, then do not deduct £100, instead deduct higher than that. Now what the government is saying, deduct higher than what you have incurred in research and development. Say for example, if you have spent £100 on research and development, instead of deducting £100, you can deduct more than that. Now what would happen is, government is allowing you to deduct more than what you should have. The eventual effect of it will be that it will reduce your eventual profits. If the profits are reduced, then obviously you will have to pay less tax. So that is the benefit of it. Now it depends on how much you can deduct if you're a large company or a small company. Now if you're a small company, SMEs, a small or medium-sized company, then the expenses that you can deduct is your normal expenses are £100. You can obviously deduct that £100, but the additional that you can deduct on top of that is £130 extra for small and medium-sized entity. So what you can deduct is you can obviously deduct your actual expenses. So first you will deduct the actual expenses, which are £100, then you will additionally deduct £130 of your qualifying research and development. Right? So your research and development expenses were £100, you will deduct that, and you'll deduct £130 of that as well. So another £130. So altogether £230 you can deduct as a research and development if your company is a small or medium-sized company. All right. Now, in the question, what the examiner does is they will give you a list of expenses. So they will tell you they have spent that many expenses on research and development, but this is total expense they have spent on research and development. But that is total research and development expense, but that is not a qualifying research and development for tax purposes. Then he will tell you what are qualifying research and development. Say, for example, the total research and development expense they have spent was £100, but they said the qualifying research and development expense was £80 only. Excuse me. What you can do is you will first deduct the total research and development, which will be £100. Then you will have to deduct 130% additional 130% of qualifying research and development, which was £80 in my example. All right. So the question was they have spent £100 on research and development, but out of that £100, only £80 was qualifying research and development. Then when you are doing the calculations, what you have to do is you have to deduct first. You have to deduct a total research and development, which was £100. Then you have to deduct additional 130% of qualifying research and development, which was in our case £80. So you'll have to deduct 130% of £80, which will be additional deduction if your company is a small and medium-sized company. Likewise, if your company is a large company, say for example, if your company is a large company, then you can obviously deduct what you have spent in research and development, your actual expenses, but on top of that, you can deduct 30% extra of qualifying research and development. Again, qualifying research and development. So £100 in our example, you can deduct £100, that one, definitely, but you can deduct 30% additional. If your company is a large company, you can deduct only 30% additional on top of what your actual expenses are, but 30% of only 30% of qualifying research and development. All right. So that's fine. Now, what happens is that what we have to do, I told you that we take the revenues and then we deduct the cost, and whatever the net amount is, that will be our profit, which we'll have to pay the tax on. Now, what happens is sometimes when we are making the accounts, what happens is the company is already in the losses. Now, if the company is in the losses, say for example their earnings are not as much as their expenses are, so they are coming in the losses. When the company is already in the losses, then there is no benefit of deducting more research and development. All right. So if the company is already in the losses, if you deduct additional research and development, then it won't be beneficial, will it? Because obviously you can set it off against the other profits, but that is in the future, and future is not certain. Now the government has given you another benefit as well. Now what the government says is, it is up to you if you are not making profits and you do not want to deduct the additional research and development. In large companies case 30% additional, in SMEs case 130% extra. So if you do not want to choose that, you have another option, and you can ask HMRC to pay you a cash money instead of giving you relief. All right. So if you have spent research and development and your company was in losses, then instead of deducting research and development additional expenses, you can go to HMRC and ask them to pay you cash, because you need cash more than the relief which will be given to you. Excuse me. Now, how much cash or how much tax credit you can take, it depends on whether you are a large company or whether you are a small company or medium-sized. All right. So we will look at the notes now in order to see how much can we deduct. Here you go. We are here on the research and development. Now, research and development relief for SMEs. First of all, it says for SMEs. Now, what is it? Research and development relief for DMEs. It's not DMEs. It is SMEs. Please make sure you rectify it. SMEs is given by allowing the company to claim 230% of the expenditure as a deduction instead of the actual cost. Right? So instead of actual cost, you take 230%. I told you 130% extra. So 100% will be the normal one, and extra 130%, so the total will be 230%. Alright, so research and development relief for SMEs is given by allowing the company to claim 230% of the expenditure as a deduction instead of the actual cost. If the company that qualifies for SMEs research and development relief makes a trading loss, so if the company is in the losses, then the tax credit will entitle. So they might, if the company is in the losses, then they might ask HMRC to give them the cash. So that is called tax credit. So tax credit means simply instead of taking the relief, you can ask HMRC to pay you cash. So tax credit means simply cash. You can understand it like that, but you cannot write it in the exam that it is cash. Please write down tax credit. That is the term which is specifically used in the tax. All right. So whatever the things which I tell you, that that is just an easy way to understand. It is not actual. It is not the word that you may use in the exam. Please do not use the word cash in the exam. Just use the tax credit in the exam, because that is the specific word for taxable purposes. As for taxation exam, please make sure you use that word. Excuse me. So if your company is in the losses, then you will be entitled to the tax credit. Then how much it will be? The tax credit is 14.5% of lower of. So 14.5% of lower of the trading loss, or the 230% of the qualifying research and development expenditure. All right. So it will be lower of these two in SME's case. Now, what happens in the large companies that you will get 130% of the expenditure as a deduction instead of the actual cost, and a large company which is incurring the losses, excuse me, a large company that incur research and development can claim an alternative above the line tax credit. Now, this is also a same thing like SMEs, but in this case it is called above the line tax credit, or ATL tax credit. All right. Now, instead of claiming the 130% tax deduction, research and development deduction, above the line tax credit will be available, and it is 11% of tax credit of that cost incurred. So it will be 11% of the cost incurred. But how to do that? It is a little bit different in this case. First, the 11% tax credit is treated as income. So first you have to do is you have to add that 11% into your income. So take the 11% of the expense and add it as the income. So the income will be increased. All right. To increase the company's tax liability, so the income will be increased and tax liability will be increased. So after increasing the income, you will calculate the tax at the rate of whatever the company rate is, which is 20%. So you'll calculate the tax rate, and what you have to do is then you can then this 10%, it says 10% is not 10%. Please make sure you rectify it again, and it is 11% again, right? Then this 11% tax credit is deducted from the total corporation tax to reduce the corporation tax liability. So what you have to do is you have to first add that into the income. So the income will be increased. Then you have to calculate the tax, which is 20%, and after calculating the tax liability, then 11% again, which will be the same amount, will be deducted out of the tax liability. All right. So that will be our research and development expenditure. So that is our research and development expenditure for large companies, right? As you can see on the on the screen. Now, sometimes I forget to scroll down the screen. Please make sure. That's why I ask you always to download the notes and keep the notes in front of you, so that if I may forgot to scroll down, then you know where I am. All right. Now let's look at the question relevant to this thing, which is research and development. It says question 32, above the line tax credit. So let's look at question 32 now. I will just go forward to question 32. Excuse me. Right, then it says part B, Gosling PLC. I think it is this one. Yeah, Gosling PLC is a large company for purposes of research and development. So it is a large company. So what would happen is will be eligible for either to deduct that expense, which will be 130% instead of the actual cost, so 30% extra, and we will be either eligible to that. If you do not want to do that, then what you can do is you can claim for above the line tax credit, so T, above the line. Alright, so sorry, ATL. So either you can do that or you can do the above the line tax credit. What happened is that is a large company, for the purposes of research and development, in the year to 31st March 2016 spent £500,000 on qualifying research and development. So these are qualifying research and development. He has already told you, and the amount is £500,000. It is £500,000. Has taxable total profits before taking into account research and development of 4.5 million, I think it is. So 4.5 million of profits before taking account of research and development. So these are the profits which are given to you, but they haven't deducted the research and development expenditure yet. Now the requirement says, in relation to the Gosling PLC, calculate the corporation tax payable. So we have to calculate the corporation tax payable for the year 31st March 2016. If the company claims research and development deduction relief, so first you have to do is, you have to calculate the R&D deduction relief. So you will have to do the normal deduction, and the second one is above the line tax credit for research and development expenditure. So the total marks are 5 for this question, and it is exactly the same way I told you. I think I have explained you in enough detail, so you can look at whenever you want. You can look at the answer. So question 32, and it is part B of the question. Actually, I will show you the answer as well, so it will be better. Alright, so in this case it was a large company. Alright, so what you have to do is, the first requirement was to deduct the do the normal expenditure. So in our case the profits were 4.5 million, I think, and the expenses were £500,000. So 4.5 million was profit. We'll deduct the normal expenses, which were £500,000, and you can deduct the 30% extra as well. So that will be our first requirement. In the second requirement, I think I've moved. Am I on track or not? Hang on, let me check the question if I'm on the track. Yeah, this is the question. So that is part B. So as you can see, deduction. So the deduction relief, first one is a normal one. So we took the profit of 4.5 million. Then we deducted the £500,000, which is normal expense, and extra 30%, which is £150,000. So that will be our taxable total profits, and we took 20% of that. That will be our tax payable. In the second case, what we have to do is, I told you, first we have to take the profits, then we have to take 11% of research and development expenditure, and we add that into the profits. So the profit will be increased. All right. So when the profits are increased, then we have to deduct the normal expenditure, which was £500,000, and that will be our total taxable total profits. Now after doing that, we'll take the liability. So that will be our liability, which will be 20% of that total corporation tax will be at 20%. So after calculating the corporation tax, what you have to do is you have to again deduct this time deduct the 11% of £500,000. Excuse me. This time you have to deduct the 11%, so that your liability will be reduced. All right. So first time it was added into the profits, and the second time it was deducted out of the liability. Now it is only for the large company. For a small company, you can either claim 230%, or you can just reduce. You can just ask for the tax credit to HMRC, which is 14.5%. But in this case, first will be added and the second will be deducted. Now, if you can see on the screen, on the answer, first it was deducted, £55,000 was first £55,000 was added into the profits, then it was deducted. Now it is the same amount. First it is added, and the second time it was deducted. So would it make any difference if I delete both of them? So if I do not add and do not deduct, so if I do not do either of that, will it make any difference? Yeah, actually it would, because if you see, it was added into the profits, but it was deducted out of the liability, right? So it has reduced your eventual liability. Now what the student think is, what's happening here is the same thing is added and same thing is deducted, then how come it is a relief? It is not a relief. It looks like that. It looks like it is not a relief, but it is actually it is a relief, because you can see that first it was added into the profits, but it was deducted out of the tax liability, because it has reduced your tax liability. So I hope that you would appreciate that. All right, now let's go back to our notes again, please. Where were we? That was research and development for large companies. Now go back to our notes, and we are on page 78 of the notes. Now it says personal accountability of senior accounting officer. Now what happens is that if your company is a large company, but by a large company I mean you are earning a huge amount of profits. In this case 200 million, your turnover is 200 million pounds, and your balance sheet total are 2 billion pounds or more than that. Then what happens is that your company's senior accounting officer will be responsible to making sure that your company is making the tax properly, you're paying the tax properly and all that. All right, so it says the company's senior accounting officer will have personal accountability for ensuring that financial system of the company are adequately maintained to accurately report the taxable profits and gains of the company. Now, failure to do that, you might have to pay £5,000 penalty, and the company must notify HMRC that who the senior accounting officer is. All right. Now, this is only relevant for theory, but examiner may ask you for two marks in the question. All right. So please make sure you know that. A group payment group payment arrangements. So say for example, there is a group of companies, and all the companies are paying the tax in the installments. And what they can do is they can just elect one member of the group to pay the tax. So although all of them will be paying the tax, but they can elect only one member to pay the tax for all of them. So it will be beneficial for administrative point of view, because it is not easier to do when all the companies are paying the tax, then everyone is going to HMRC to pay the tax. So in order to reduce the administration, you can elect one member to pay the tax. All right. The second last topic of this part of the lecture is employee shareholder. Now, employee shareholder is just a shareholder. What happens is that when you are working for a company, now companies, although they are paying you salary, but they are paying you some benefits on top of salary as well, right? So the benefits like the benefits like unfair dismissal compensation, statutory redundancy pay, or remuneration, or employment rights. So there are some benefits, the extra benefits that you're getting on top of salary. Now, although you're getting extra benefits, the company's policy is to give you the benefits. But when you started the job, your boss said that, all right, okay, what happens is that I will give you the salary, but I will give you some benefits as well. This benefit, that benefit, and that benefit. Now you have the option, although you will get the salary, but either you choose them extra benefits, or instead of choosing them benefits, I'll give you some shares in my company. I hope you got it. So what you will have to do is you can either, so salary is a fine thing. You will get the salary in any case. You will get the salary, but you will get extra benefits. Now, instead of taking the benefits, you have the option to choose between the extra benefits and the shares in our company. So it is up to you. Now, if you choose to give up the extra benefits and take the shares in the company, then you will be called employee shareholder. So you will have shares in the company for which you work. So that is called employee shareholder. And the employee shareholder, then you will be known as employee shareholder. All right. So it says employee shareholder is an employee with certain employment rights like remuneration, unfair dismissal compensation, statutory redundancy pay to be given up in exchange for employee company shares. Now the following conditions must be satisfied. Now these are the conditions which you must know, and it is very, very important as far as exam is concerned. This employee shareholder is very, very important. Examiner might ask you up to 5 marks for this theory. So you must know that. Alright, so what are the conditions for employee shareholder shares? Employee and employer must agree to the terms of employee shareholder. Employer must give a written statement that he is employee shareholder. So he must tell in writing. Employer must give employee at least £2,000 worth of shares. So the minimum amount of shares that can give is worth £2,000. Employee must not pay for the shares. So that £2,000 worth shares will be free. Minimum £2,000. If employee obtains relevant advice from the independent advisor, so before taking up the shares, employee can go to independent advisor to ask them which option shall I take. All right, so they can go to the advisor. Now, if they go to the advisor, then who will pay for the advisor's fee? Your employer must pay for the fee. All right, and employee must wait for 7 days of taking advice before accepting or rejecting the shares. So when you have gone to the advisor, and you must wait after taking the advice, you must wait for 7 days before making a decision about the shares. All right, so these are the conditions for that. Now, if you have accepted the option of the shares, there will be income tax charge on the employee if the employee holds less than 25% of the issued share capital. Now, what happens is that when you have accepted the shares, if you hold less than 25% of the company's shares, which most likely you will be, you will most likely be holding less than 25% of the company's shares. In that case, you will have income tax charge, so income tax penalty. The taxable employment income will be calculated. So what will be the penalty? What will be the charge? What happens is that whatever the amount you hold in the shares in the company, say for example you have been given £5,000 or £10,000 worth of shares in the company. So if you have given £10,000 worth of shares in the company, then that £10,000 will be taken as a benefit, as employment benefit, but only £2,000 of that will be deducted, which in our one of the conditions is that £2,000 will be free. So that £2,000 will be deducted out of that. So we'll take market value of the shares less £2,000. On disposal of the share that gained, the first £50,000 worth of shares are exempt. So when you dispose of the shares, first £50,000 are exempt from CGT, whereas disposal of excess shares will be a capital gains, and it will be calculated in the normal way. On disposal of the share that will loss, this loss will not be allowable. So on the loss will not be allowable. The next one is the management expenses of investment company. So for example, if you are doing investment company, if you have an investment company, say for example you are dealing with the properties. Now the investment companies do not have much expenses. The major expense they have is a management who are responsible for that. So admin officer, manager of the office, and not like that. Now what happens is that you can deduct the management expenses out of your profits. So the major expenses, management expenses anyway, so you can deduct them expenses out of your profits. Not only you can do that, if you still have, after deducting them expenses of the current year, if the expenses are still left, then you can carry that forward into the next years as well. All right, so that was management expenses of investing company. Now I'll just tell you a portion of question as well this time as well. Question 32 we have done it. 28 patent box we have already done it. Question 22 part A is relevant to employee shareholder. Please make sure you do that as well. And that is question 22 part A, which is relevant to employee shareholder shares. Please make sure you do that because it is important. Question 22 part A1. After finishing the lecture, whichever questions I told you, please make sure you have a look at them and do that. The exam kit which we are using is BPP exam kit. So please make sure you, I assume at this level you have already bought one. But if you haven't bought one, please make sure you buy one, because it is very, very important to do the practice, because practice is vital in order to pass the exam. All right, that's it for this portion of the lecture. And this lecture is continuing in our next video. So please stay with me, and I will see you in the next lecture. Thank you and goodbye.